Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, I tell.
All right. Hey guys, my name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And guys, you are in the right place if you want the data, not the crazy headlines, but the real data, the tips, the tricks, the strategies, all the info that you need, and of course the answers to your questions, so you can go out and make better real estate and mortgage decisions for you and your family. And man, oh man, what a bundle of news. A lot of it was really encouraging in the world of the economy, real estate, mortgage, interest rates. A lot of information and data was released this week. Almost all of it super, super encouraging. So we're going to dive into all of that. Is 7% the new 5%? We're going to cover that too. And what do I mean by that? We saw activity spikes in 2022 around the 5% interest rate environment, and we're seeing the same thing now around the 7% market. So we're going to dive into that. And is that a trigger point for you to seize the opportunity and make a move in the real estate world of today? So we're going to talk about that. Wow, that was pretty dramatic, right? The real estate world of today. What was that guy's name? Bob Fontaine, or I think La Fontaine, the most amazing movie trailer voice ever. But anyway, we're going to talk about that. We're going to touch on the NAR lawsuit and what does that mean for real estate commissions? Are real estate commissions going the way of the stock brokerage commissions once the E-Trades and most recently Robinhoods of the world entered the marketplace? We can talk about that. I'm getting a lot of questions off the air, so I just want to throw that out there. If you want to talk about it, we'll do our best to keep up. It's still a very fluid situation, but I'm talking to a lot of agents that are very concerned with what the next steps may be. A lot of consumers excited that this may mean that they're not going to have to pay as much commission moving forward. So anyway, we can talk about all of that. We're going to get to your questions. Guys, the show is driven by you. Questions or comments, please call or text 855-462-7292. That is the Anytime Hotline. That number again is 855-462-7292. You can call or text. That is the Anytime Hotline. And guys, if you need us when we're not on the air, that number rings to my office during the week, but it's the dedicated line for the studio. When we're doing the show, it rings in here, and we forward it to the office the rest of the time. So you can get us anytime on the Anytime Hotline, or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Right under my ugly mug is a big orange button that says Get Your Questions on the Air. If you click that button, type your question in, Jen will read it on the air for you. And speaking of Jen, in the co-pilot seat over there, some would say the pilot seat, she definitely runs the show, but she is womaning the hotline and watching for your emails and texts. She is standing by and ready to go. Looks like she might already be fielding some comments, which doesn't surprise me since I've been known to break into song and dance on the air, and some people may already be asking that not happen this week. But anyway, guys, let's dive into the data. So super, super encouraging data around inflation. And because of that, there's some optimism in the market regarding a pullback in the interest rates. Some people are calling for the Federal Reserve to start cutting rates as soon as the first quarter of next year, which, guys, I don't think we're going to see that happen, and we'll touch on that in a second. But one good thing that came out of all of that data was a pullback in the interest rate environment. And it was just a couple weeks ago that we were over 8% in the low 8s and holding firmly. And we've pulled all the way back to the mid 7s and high 6s. I mean, we locked rates this week in the mid 6s to low 7s, which was awesome. And because of that, that seems to be the new threshold of tolerance for money. Guys, clearly the market has demonstrated, and we've said it for 20 years, supply and demand is the only thing that drives prices. So prices have continued to hold, and in a lot of markets still appreciate in the face of these increasing interest rates. And the 8% interest rate environment did not do anything to curb growth of pricing. It curbed activity, but it didn't drive prices down. And I think because of that, people are realizing that it is supply and demand. And if we can get into the game at 7% instead of 8%, that's more attractive. Let's jump in. And we saw that in all of our offices on the team. Once rates came back a bit, we saw an increase in activity, and CNBC reported the same thing nationwide, an increase in mortgage applications. One thing I find fascinating is an increase in refinance activity also, which could indicate some challenges for some people in the economy, because the refis of today are out of necessity, not desire, meaning a lot of people are doing debt consolidation or pulling some cash out to pack it away in case they need it in the future. It's not the convenience refis to lower the payment and lower the interest rate that we saw, 24 or so months ago. It's people who have to refi. And we're seeing a lot of that in our personal practice around the REC refi product. And that's the debt consolidation loan that we offer, reduce, eliminate, and consolidate, REC refi. So we've seen an uptick in that. And the data supported that. The 2.87%, I believe, was the uptick in refinance activity. So it's encouraging. Rates seem to be tolerable in the 6s and 7s. People are, ready to play ball and buy and sell real estate at that cost of money. So I wanted to throw that out there. If you're looking for an opportunity, this may be it. This may be a target for you. And guys, I encourage you too, not to look too closely at rate, look at your budget. We've talked about that many, many times, because if your budget works trying to save an eighth or a quarter, the way rates have been swinging, they might go the other way against you as quickly as they're coming back. So it's really, really tough to time the market. They call it catching a falling knife. And it's not for the faint of heart. So the good news is we seem to be in a stable environment, and we've pulled back a bit, which was nice news for a lot of people. So that's where we are interest rate wise. Now, the NAR lawsuit, right? A lot of people are anticipating that this is going to do away with the realtors. And I got to thinking about it. I've been having a lot of conversations about this. And guys, I don't know how many people are tuned in to exactly what's happening, but the class action lawsuit, the $1.8 billion judgment, man, those are huge, huge numbers all around the commission structure of a real estate transaction guided by the National Association of Realtors. So I went back and looked at some of the historical data around stock brokerage. You could probably do the same thing for travel agents. I think it was 90. Oh, God, I wish I would have written this down. It was in the 90s. It might have been 98. E-Trade came onto the market, right? And it was in the early 2000s. I remember that Super Bowl commercial E-Trade had. He's got money coming out of the wazoo, and we all got a good laugh out of it. The platforms, the technology-driven platforms, greatly reduced the stock brokerage commissions, lowered the threshold, I guess, if you will, for people to buy and sell stocks. Certainly made it more convenient and more affordable. Now, what they lacked was the guidance behind the trades, which some of the brokers would say that was their value that they were adding in exchange for the commission. And I'm not arguing for or against any of this. I'm just saying that was one place that we've seen consistently commissions being reduced, but that driven by technology, not so much by lawsuits. Now, in the real estate world, there are some significant technology players who are salivating on the sidelines, seeing all this disruption in the real estate commission conversation, thinking they're going to benefit from it. That there's an app that you could buy and sell real estate with a couple clicks. Now, we're not there yet, but if we get there, it'll be super, super interesting to see what comes of all of this. And we can talk about it if you have questions. Hey guys, you hear the music? You know what that means? Or do you? Does that mean I am going to break into song? No, not yet, guys. That's my cue. We'll be back in a few. Sit tight on the other side of this very, very short break. We'll be back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And man, we are super excited that you're spending a bit of your day with us. Thank you for joining us. If you've got questions or comments, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. Jen is womanning the hotline, and she'll get your questions on the air. Or just head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Click that big orange button. You can't miss it unless you're temporarily distracted by my ugly mug there on the intro video. But click that orange button. You can type your questions in there, and Jen will read them on the air for you. And I'm going to dive in just a minute, but I wanted to share this. Guys, a friend of mine, Brian Stevens, over at Mortgage Shots, said something that I thought was brilliant this week. He went back and he was reviewing the data over, I think it was a 20-year period, housing prices, rental prices, and salaries, right? The growth of all of the three of those categories. And to no one's surprise, salaries has not kept up with any inflationary benchmark, certainly not housing, either rental or owning, but it was really very vivid to see it play out over this period of time on the charts. Significant growth in both rental costs and housing prices to anemic growth in income, which is concerning for everybody because it means even the alternative to ownership is super expensive and at all-time highs. And here's what he said that just totally blew my mind, because you guys know I geek out on the data each week and we try to make sense of all of this so you have strategies that you can go out and make use of to benefit from in the world of real estate each week. He said, if you were to buy a home today, your mortgage payment will likely never be higher. Think about that for a minute. At these interest rates, everyone believes sometime in the future there'll be an opportunity to refi and lower your rate and lower your payment. So he said one more time, if you were to buy today, your mortgage payment would likely never be higher. However, if you were to rent today, your rental payment would likely never be lower. Now let that sink in for a minute. If you rent today, your rental payment will likely never be lower because historically it's marched up, and he showed the data to support this. So if a mortgage payment and a rental payment start off in a similar range cost-wise each month, then making the purchase makes way more sense because a fixed rate mortgage has a stable payment, with the exception of the occasional increase in insurance and small incremental increases in taxes. The mortgage payment stays consistent for 30 years, 15 years, whatever the term of the fixed rate is. So I just found that super insightful because we get so caught up in, is 7% the trigger point? And I even touched on it in the opening segment. 7 seems to be the new 5, because when we broke past 5 in 2022, we broke past 5, past 6, pulled back to 5, and saw a flurry of activity. Well, we just saw the same thing happen. We broke past 7, broke past 8, pulled back to 7, a flurry of activity. So that's why I said is 7 the new 5. But his point really demonstrated that if rents continue to go up, but mortgage payments stay constant, that it was really hard to argue with the data. So I just wanted to share that because I thought that was a really good illustration. So with all that out of the way, I know we've kicked an ant pile with a lot of this. So I'm going to toss it over to Jen and get some questions on the air. Hey, Jen, go ahead with the first question.
Ken used the website for this. I'm considering a FSBO. I spent decades in the marketing business and know marketing better than 99% of all realtors. What are your opinions about flat fee listing agents just to get it into the MLS? And what's the best way to do a sale contract? I am willing to pay a reasonable percent to a buyer's agent, just don't think any seller's agent does anything much for their percentage.
All right, Ken, this is an awesome question, and thank you for using the website. So we're seeing a big uptick in people wanting to go the buy owner route. And some of it is people just like you who don't see the value in agency. Another category seems to be the guy who's always done everything himself. He's remodeled the kitchen. He's remodeled the baths. He built his own deck on the back of the house. He's just the guy that rolls up his sleeves and does everything he can do to best serve his family and eke out all of the profit in all of the big transactions. I know a lot of guys like that. I'm at the hardware store in Lowe's and Home Depot every weekend with guys like that, and I do it myself. And then lastly, we're seeing a group of people who feel like they didn't get the best representation in the last 2 or 3 years. They were encouraged to pay more than the property was worth. They waived their appraisal. They waived all their contingencies, and now they feel like they kind of got stuck with a pig in a poke, and they're trying to recoup as much of that as possible when they sell it and do that without paying a commission. So great question. Guys, we created a whole program for the for sale by owner, and you can find that at fsbozilla.com, affectionately called FSBOzilla. There's a book, the whole thing's there. It's all free. Check it out. Let us know what you think. I know Ken got the FSBOzilla 5-pack, so I'm super interested to see what you think of it, Ken. But let me answer your question. So the flat fee agency is a great idea. It gives you full exposure on the MLS. And guys, the MLS is what all the agents use to know that your property's for sale, and if there's a commission being offered, it'll be disclosed in there. So they know that there's an opportunity for them to show your property in exchange for a commission. So that's kind of the middle ground, right, Ken? It's a great opportunity for exposure, and some of the flat fee costs are quite low on the front end, which is a great opportunity. But a lot of people start with the pure for sale by owner, right? They'll go sign in the yard. They'll list it on Zillow. Guys, most people don't know this, but you can list your for sale by owner on Zillow for free and get a lot of exposure just because you're on that platform, which is a great opportunity. And yes, you're going to get a ton of phone calls from agents who want to list your property, but also who want to sell your property, and they'll negotiate a commission with you on the spot. And if you don't want to take those agent calls, there's a strategy for that in the book as well. But anyway, a lot of people will start straight for sale by owner, and then if they're not getting the exposure or the traction, they'll go flat fee, because the for sale by owner on Zillow, that whole program is free. And if you use FSBOzilla, that's free too. And then they'll transition into a flat fee relationship where you pay an upfront fee to a listing broker to get you on the MLS, and it's usually bare bones. And then if that doesn't work, they'll consider full agency. So great question, Ken. And the second part of your question, most title companies or title attorneys will assist with the structuring of the contract if you're going to close the transaction with them. And you will need a title attorney or a title company to close your transaction, especially if there's a mortgage involved with the buyer. So you can lean on the title relationship for guidance on structuring the contract. And if you're paying a realtor a commission, they'll certainly bring you a completed contract, and you can have the title attorney review it for you. But great question, guys. We're seeing a lot of activity in this space. Check out fsbozilla.com if you are at all interested in learning more. But guys, you hear the music, you know what that means. That is my cue. We'll be back in a few. On the other side of this very short break, we'll be back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we're back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. Guys, if you have questions or comments, you can get them on the air by calling or texting 855-462-7292. That's 855-462-7292. That is the Anytime Hotline, and Jen is womaning the hotline. She'll get your questions on the air, or you can head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Right in the middle of the page is a big orange button that says Get Your Questions on the Air. Click that button and you can shoot her your questions that way. And guys, we're going to dive right into those questions, but I just wanted to wrap up what we were talking about when we went into that break, which was the whole for sale by owner thing. And I say it all the time. It's not easy, but it's simple if you follow the instructions. And the three big things that are hurdles for most for sale by owners are getting your property priced correctly in the beginning. A lot of people wildly overpriced because they're emotionally attached, or wildly underpriced because they just don't know how to dissect the data. And we've got the free value report that we offer. We use the value report almost daily in our practice, where we're looking at, it's not really a desktop appraisal, but it's way more detailed and accurate than one of those online estimates. So we're happy to give that to you. So you've got a great baseline for structuring a price for your property. And then stranger danger is a real thing. So we've got a program to vet all of the buyers for you, so you're not showing your home. You're not letting anyone in your home that's not been identified or vetted. And then the number one reason that a for sale by owner deal falls apart before closing typically is the financing. You know, how do you know the person is qualified? How do you review the documents? Are you even comfortable asking for the documents? And that program, FSBOzilla, takes care of all of that and so much more for you. So if you're at all interested, I wanted just to kind of clean that up and throw those additional details in, because there's so much more available to you at that website, FSBOzilla.com. And it's not right for everyone. It's definitely a lot of work, but if you're that guy, you can save a lot of money and take that equity with you for your next move. So, all right, let me throw it over to Jen and let's get some more questions on the air. Hey, Jen, go ahead.
Anna emailed this one. I'd like to buy a new house before I sell the one I currently own. Can I take an equity line for the down payment on the new house?
Hey, Anna, that's a great question. You can. Most equity lines are going to have what's called an early termination fee. So you'll want to factor that in. And then you're going to have to qualify for all of the debt, right? You're going to have to qualify for the existing mortgage, for the equity line, and for the new mortgage. Just remember that, because a lot of people don't think about that. They think, well, I'm just going to sell this first house in a couple of months. Why does that count against me? And it does until it's sold. They're going to count that mortgage payment against you. Another strategy is what's called a bridge loan. And you can get a bridge loan against the equity in your property. And you're basically doing the same thing, although you're doing the bridge loan and the mortgage on your purchase with the same lender. And everybody knows it's just a short-term bridge loan. The fees for the bridge loan are greatly reduced, and there's no early termination fee because everyone's aware of what the strategy is. If you go the bridge route, however, you'll want to make sure you're able to sell that property in a 6-month time period. If you can't, they'll often extend you another courtesy 6 months, but it's not something you can hold indefinitely, as you may be able to with an equity line. However, the equity line can only be on your primary residence. So if you were to move to a new primary, that could cause problems and have the equity line called due. But it could work if your strategy is very, very short term and you're able to qualify with all that debt. And there are other strategies to consider as well. There's a company called Ribbon that will essentially allow you to pay cash for the new property until you sell the property you have. And they act like a rich uncle, for lack of a better word. That's one thing to consider. Another thing a lot of people just don't really dive deep enough with their agent into is post-closing occupancy. You could sell your property, have an extended close period. Let's say you close in 60 days instead of 30. And then once you close, the buyer, the new owner, gives you 60 days post-closing occupancy. Technically, it's got to be 59 or less if they're buying the property as their primary. But now you've given yourself 4 months after you've signed the contract to find a place and close on it. So those strategies are by far the most cost effective because they don't involve additional financing. So I hope that helps. And if you need more information, please call or text. I'll be happy to jump on a call and answer any questions that you have. Hey, Jen, do you have another one?
Amber sent a text. This may sound crazy, but I have a personal line of credit for $50,000 at my credit union. Would it be crazy to use that for a down payment on a house?
Would that make me crazy? It won't make you crazy, but you can't do it. You can't use borrowed funds for the down payment. It would have to be gift funds, but borrowed funds can't be a down payment. And somebody's going to say, well, wait a minute. You just told the other person they could borrow equity line funds to buy. That's their money already. They're just borrowing against their own equity. A personal line of credit is considered borrowed funds when it comes to a down payment. So it wouldn't work, but not a bad thought. If you want some creative strategies to work on either a smaller down payment or some down payment assistance, let's jump on the phone and see if we can't figure it out. But using your personal line of credit's not going to help in this instance. But great question. I appreciate that. Hey, Jen, toss me another one.
Caesar sent this. My girlfriend and I are splitting up, but we own a house together. I want to keep the house and buy her out. She won't sign over the deed unless I refi her off the mortgage. I see her point, but we have a super low rate and I hate to lose it. Is there an option other than refi?
Hey, Caesar, she's a smart one. She's a smart one. I say it all the time. Do not quit claim yourself off the deed. Don't own the debt if you don't own the asset. And that's exactly what her resistance is in this. And you're right. At least you're being fair. You see the value in her stance. This is an interesting question. One thing I would love to know is, by any chance, do you have an FHA loan? Because you could call your servicer. Your servicer is the company you make the payment to, not necessarily the origination company. So the bank or mortgage broker that you got the loan originated through originally might not be the one that collects the payment now. That company is called the servicer. Contact the servicer and see if your loan is assumable and if you could assume it as an individual. Now, assumptions take time. They don't happen in 30 days. Assumptions move at their own pace. But if she's willing to hang in there with you, that might be a strategy that gets you the mortgage that you currently have, assuming that you have the cash to buy her equity position out. So that would be my first thought. Try the assumption route. Let me know if that works. If it doesn't work, maybe we can figure out another strategy for you. But that's a great, great question. And that's another reason why you need to go into any purchase relationship as unmarried people with eyes wide open, because this is what you're faced with if you split. 2 people on the mortgage, 2 people on the deed, 2 people no longer happily ever after. You've got to figure out who's going to keep it, who's going to refi the one off the mortgage, off the deed, or are we just selling it? It adds an awkward layer of conversation to an already difficult time if you're splitting. But it sounds like you guys are adults playing fairly. So thank you for bringing that topic to the air, because everybody's got to be aware of that. Hey, guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this short break. We'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And if you have questions or comments and you want them on the air, we still have time to get a couple more in. Call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline, and Jen is womaning the hotline, and she'll get your questions on the air. Or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Right in the middle of the page, click that big orange button that says get your questions on the air. Type in your questions and Jen will take it from there. But hey, speaking of Jen and your questions, I know she's got some stacked up back there, so let's get to it. Hey Jen, throw me another question.
Cynthia's asking, we need to do a rec refi. We really should have done it last year. Now we don't have much choice. My question is, can we take some additional money out to help our daughter? Or will that make it a cash-out refinance?
Hey, Cynthia, this is a great question, and I want to thank you for it because this is insightful, right? You know the difference already between a rec refi and a cash-out refi. So I appreciate this question because it's going to give me an opportunity to explain the difference. But first, to answer your question, it depends on how much additional cash-out that you want, because you can do what's called a limited cash out rec refi and still qualify under that debt consolidation refinance program. And guys, if you're wondering what we're talking about, REC stands for Reduce, Eliminate, and Consolidate. And it's our debt consolidation loan program here that allows you to roll all that high interest rate debt into a refinanced mortgage. And most people are super surprised, even in this elevated interest rate environment, to learn how much they can save. And guys, head over to RECREFI.com. That's refi.com. There's a calculator there. There's no sign up forms, no gotchas. Just play with the calculator and see if it makes sense to you. So to explain the difference, guys, if you're going to take out cash with the refinance, that's one level of risk. So a cash out refi is priced differently than a debt consolidation refi, which is priced differently than a rate and term refi. Now, the rate and term refi is traditionally done just to lower your interest rate. Or in some cases, if you're refinancing an FHA loan into a conventional loan, a rate and term refi could be just to get rid of the mortgage insurance component. So that's rate and term refi. A debt consolidation refi, or the rec refi in our case, is designed to lower your monthly expenses. So putting you in a better cash flow position each month. Where the cash out refi is often increasing your monthly outflow. Regardless of what you intend to do with the cash, on paper, you're taking a larger loan and in this environment at a higher interest rate. So your monthly expenses are going up. So there's three different categories and they're priced according to risk. So good on you for knowing the difference between a cash out refi and a rec refi, but just know that you can do a limited cash out rec refi and still get the benefit of that debt consolidation pricing. So I'd love to talk to you more about it, though. It sounds like there's some moving parts that I would need to get my mind around. But great question. I appreciate that. Hey, Jen, can you throw me another question?
Ralph sent this through the website. I have an assumable FHA 4% mortgage, but it is only about a third of my probable house sale price of $450,000. Is this any incentive for a buyer?
Hey, Ralph, this is a great question. And this is the common challenge with an assumable mortgage in today's environment. So I really, really appreciate you shooting this one over to us via the website. And thank you for doing that. Thank you for checking out the website. So guys, Ralph's got let's just call it $150,000 mortgage on a $450,000 house. And it's assumable at 4%, which is super appealing considering we're in an interest rate environment around 7%, 7.5%. The challenge is somebody's going to have to bridge that gap, meaning to do a straight assumption, they're going to need to bring $300,000 into the deal to assume that $150,000 mortgage. And it's doable. It's absolutely doable. And some people will surprise you with how much equity they're bringing from the sale of their current home. And fun fact, FHA is not just for first-time buyers. They could sell a home with an FHA mortgage and come assume Ralph's FHA mortgage back to back, no problem. Build additional time into the transactions because, as I mentioned a moment ago, assumptions are slow. But that $300,000 may be a challenge for a buyer. Some people will ask the servicer if they can do a second mortgage. And guys, the servicer is who to call. Not a new mortgage company, not the bank, but the person who is collecting Ralph's payment each month, whoever that entity is, that company. That's who you will contact if you want to assume Ralph's loan to start the process. They have an assumption division. It's not a new loan origination, so we can't even help you. We can guide you. I can answer all your questions and happy to do so, but we can't originate an assumption. So you would start the process through Ralph's servicer, and you may request a second mortgage, but it's at the sole discretion of the servicer. And a lot of times they're not willing to do it. Certainly worth the phone call and worth the steps if you're in the position to bridge that gap, at least a portion of that gap, and maybe a second mortgage would be an opportunity with the servicer. But great question. A lot of people are trying to figure out how to make assumable mortgages work in this environment, because if two people have a $500,000 house for sale and they're side by side, and one has an assumable mortgage at 4%, and one has a conventional mortgage at whatever percent, it doesn't matter, it makes the house with the assumable mortgage more attractive in today's environment. But great question. I appreciate that. Hey, Jen, can we get another one in?
Elsie sent this one in. What does selling my house with a subject mortgage mean? I keep getting phone calls from people wanting to buy it this way. Is it like a rent-to-own deal? Thank you.
Hey, Elsie, I bet you do get a lot of phone calls. You probably have a low mortgage interest rate too. I'm not a fan of selling anything subject to a mortgage, and I'll tell you why. Selling it subject to, basically you're letting them take over your payment for you. There's no transfer of debt from you to that person, but you're quitclaim deeding your property into the buyer's name, and they're saying, okay, Elsie, we're going to give you a check for this, and now we're going to start making your mortgage payment. The challenge is, just as I mentioned to a caller a few questions ago, you don't want to own the debt but not own the asset. That's exactly what's happening here. So you're putting yourself at risk because the mortgage is in your name, but the house is now in the person who you sold it to's name. So for that reason, I'm not a fan. And then there's the whole thing about the due on sale clause. And people will argue with me all day that I'm too conservative. It doesn't happen. But there's a due on sale clause in your mortgage that could trigger you to have to pay that mortgage off in full if the ownership changes. And as soon as you deed the property from yourself to a buyer, the ownership has changed. And again, investors will call you all day and tell you that never happens. But I can drive up and down the highway in a posted 55 mile an hour speed limit, going 65. I can do that for 5 years. And one day I can pass the wrong cop who's in the wrong mood and get a ticket because I am violating the law. I'm violating the speed limit. There's no difference in this instance. Just because it doesn't happen all the time doesn't mean it can't happen, and doesn't mean doing this violates the due on sale clause. So Elsie, I'm happy to walk you through details on alternatives, but selling your property with a subject to is not a rent to own. Rent to own, by the way, is a smarter way to do it because you still own the property. You can do a lease option, you can take a down payment, and you can give them certain period of time to buy the property, get themselves mortgage ready, and buy the property outright from you at a predetermined price. That's a lease option. A rent to own works very, very similarly. That's much smarter for you as a seller than a subject to arrangement. And that's what it's called, selling subject to. And I could go off on a tangent on this, guys. If you have additional questions, we can dive deep. We could do a whole show on it if you want to. I get wound up, especially because people just don't understand the risk that they're putting themselves in as sellers with this. As a buyer, it's a wonderful opportunity. As a seller, not so much. But anyway, guys, you hear the music. You know what that means? We have wrapped up another week of the Mr. Mortgage Show. Guys, if you need us during the week, check out MrMortgageRadio.com. That's MrMortgageRadio.com. All things in the Mr. Mortgage universe can be found there. We post a bunch of data to the Facebook group. There's links to that and so much more at MrMortgageRadio.com. That's the easiest way to reach us when we're not on the air. Otherwise, join us next week right here, same time, same station. Guys, have an awesome week.